Good afternoon. My name is David Lubroff. I'm the Joint Center's Director of Fellowships and Events, and it's my pleasure to welcome you to the first of what will be a lively series of events this spring. Before we begin, I want to let you know about some other upcoming talks. We have a very busy schedule over the next month. 2 weeks from today, on Friday, February 20th, we'll have another online webinar featuring Al Herman and Peyton Whitney, the Joint Center researchers, discussing their recent working paper with the pandemic surge in house prices. The following Thursday, February 26th, we'll be co-sponsoring an in-person only talk here at Harvard featuring Elizabeth Delmel, professor at UPenn. We'll be talking about how AI captures perceptions that shape neighborhood design. That's co-sponsored with Harvard's Mahindra Humanities Center, the Center for Geographic Analysis, and the Department of Urban Planning and Design. The next day, we'll have an online-only roundtable discussion on using design competitions to improve the quality of housing. This will be the first of three online roundtable discussions that will inform the next State of Housing Design publication, scheduled to be released. On Thursday, March 6th, so roughly a month from today, Boston Housing Authority Administrator Kenzie Bach will give the 25th annual John T. Dunlop Lecture. She'll be speaking on the past, present, and future of public housing. That will be both in person at the Graduate School of Design and online. And on Friday, March 7th, Justin Katz, who's one of our Meyer doctoral fellows, will be speaking about his dissertation research on did mortgage rate locks lead to rising house prices. So it'll be a busy month up to the spring break. You can find more information about these and other events on our website. Now on to today's event. We'll be hearing from two graduate students who are our 2025 Gramlich Fellows in Community and Economic Development. This is a fellowship for over 2 decades that has given graduate students the chance to investigate and research topics of interest both to the Joint Center and to practitioners in the NeighborWorks America network. NeighborWorks America is our co-sponsor of this terrific fellowship. The application deadline for next year's fellowship, for the next summer's fellowship, is a week from Tuesday. We will hear first from Ariella Amit, a Master of Urban Planning student at the Graduate School of Design. She'll be speaking about her research on how community-based organizations are responding to the rising cost of insurance for multifamily housing. And then we'll hear from Zack Lively, who is also a Master of Urban Planning student at GSD. He'll be talking about the experiences of community-based organizations that are developing limited equity cooperatives. Both Ariella and Zack will speak for about 25 to 30 minutes, and then after each speaks, we'll take questions for about 5 to 10 minutes. I'll moderate. Please use Zoom's Q&A to submit questions that you'd like me to consider. Apologies in advance. We won't be able to get to all of your questions, but we will share them with our speakers. We'll wrap up around 1:30 p.m. Videos and copies of the slides will be posted on our website early next week, and look forward later this spring to papers by both Ariella and Zack summarizing their research, which will be published both by the Joint Center and NeighborWorks America. Ariella, it's all yours.
All right. Thank you, David, for that introduction. Good afternoon, everyone. As David said, my name is Ariella Amit, and I am currently a Master's of Urban Planning student at the Graduate School of Design. And thank you all for coming to this presentation titled Weathering the Storm, Managing Property Insurance Costs in Multifamily Affordable Housing. And the research that informed this presentation took place last summer and consisted primarily of a series of interviews to compile insights that will hopefully serve as a useful tool for affordable housing organizations both in and outside of the NeighborWorks network. So the overall question that I arrived at was, what strategies can multifamily affordable housing organizations use to manage volatile property insurance rates? And throughout this presentation, I will share with you how I have addressed this question. I will begin with some context on insurance markets and on the experiences of NeighborWorks organizations. Then I'll move on to discuss how the literature creates somewhat of a gap for available insights on geographically diverse, multifamily affordable housing organizations' experience with property insurance. Then I'll move on to the research method I relied on to compile strategies for managing costs. And finally, I will review the key insights from those interviews. So I'd like to contextualize this presentation by saying that there are a few forms of insurance that a commercial property would typically need to procure, including property, builder's risk, and casualty insurance. However, the casualty market is particularly difficult right now. And I know that some of you might be wondering about the choice to research property insurance specifically. And there's certainly an urgent need for research and compiling strategies to manage casualty insurance rates and availability, as well as builder's risk. That being said, this presentation and my research as a whole will focus primarily on strategies for managing property insurance rates. And although the property insurance market is not at its worst currently, and organizations might be feeling some amount of relief, other organizations continue to face challenges in the space. So for those of you that may be less familiar with property insurance markets, I want to quickly touch on the spectrum of public and private markets, so that we're on the same page when I discuss strategies later in the presentation. The organizations I spoke with primarily procured insurance in the private market, which consists of both the standard market and the excess and surplus market, or ENS, as many people refer to it. The public market is a state-run market that typically acts as an insurer of last resort, and it's often prohibitively expensive. Okay, to give you some context on the property insurance market in general, this chart shows quarterly percentage changes in overall US commercial property insurance rates, starting from around Q2 of 2021 on the left-hand side and going into Q2 of 2025 on the right-hand side. An important note here is that the property insurance market experienced a hard market from 2018, which isn't shown on this chart, up until about 2024. And so we're seeing increases in property insurance rates by percentage each quarter and recently overall decreases. Now, of course, this doesn't mean that every single property is experiencing a decrease in their rates. If an organization was struggling, say in 2024, a small decrease or no change at all to their insurance rates can still put them in quite a difficult situation. And so although things are getting better, it's also important to note that insurance historically runs in cycles. So there will be periods of hard market followed by periods of soft market, and we can continue to expect volatility here. To give you some context on how this has impacted NeighborWorks organizations specifically, this is data from a property insurance survey of network organizations in 2024. We saw about 85% of the network reporting premium increases, of which 80% were seeing increases of up to 25% on their premiums. And additionally, we saw about 20% of the network reported deductible increases in 2024, of which the median deductible increase was around 150%. It's important to note here that this deductible increase is not organizations electing to increase their deductible in order to attempt to decrease premium rates. And of course, if you don't have a significant deductible fund on hand when an issue comes up, this can pose many challenges for organizations. So increases in insurance rates nationally and within the NeighborWorks network can happen for a number of reasons. And these are some of the reasons within the NeighborWorks network that were cited in the survey. So there's an increase in replacement costs. Construction costs since around the COVID-19 pandemic have increased dramatically. The cost of repair has increased. There is a limited market and capacity issue. So if there's a lot of demand for insurance and insurance companies have a lot more power, they can follow their overall mission of profit and sort of price things as they like and also pick up and leave as they like as well. Claims and loss history is a reason that is discussed quite a bit. But if there's a claim one year, then for the next few years, even premiums can increase. Natural disasters and weather events can also impact insurance markets, both regionally and statewide. Location can be important as well. The age of property is important. The affordable housing stock nationally is older on average than the market rate stock. And so things like the age of the property, as well as how old the roof, electrical wiring, or electrical paneling are, all sort of factor into property insurance being more expensive. And the last cited reason was the renter population. So there's a lot of stigma amongst insurance companies that affordable housing is not as profitable for them as market rate housing is because of ideas that it might be riskier. And of course, insurance companies aren't really admitting to this, but it has come up anecdotally as an issue for increases in property insurance. Now I want to circle back to the discussion on climate and weather events. This is a map showing the National Risk Index, starting from the lighter blue, which is indicating very low risk of weather events, going into the darker blue, which is showing the highest risk. And we can see, perhaps unsurprisingly, that coastal areas have much higher risk than other areas. But it's important to note that some states might look better, but no one state is sort of entirely immune to weather events. And there are pockets of each state that have higher risk than other areas. And as climate change progresses, we'll sort of continue to see this risk change. And to give you some context about sort of where rental units are in this picture, the Joint Center in 2024 released a rental housing report that demonstrated that around 18 million rental units nationwide are under threat from environmental hazard. And so, of course, we're seeing single family homes being impacted by extreme weather events, but rental properties are also under threat here. Okay, going back to increases within the NeighborWorks network. Of course, NeighborWorks member organizations have had to respond to these increases in a number of ways. And in market rate housing, it's typically easier if you have an increase in property insurance, as you can often pass that cost off onto renters. In affordable housing, that's not always possible. And where it is possible, it's often not ideal to continue the mission of affordability. However, affordable housing organizations are put between a rock and a hard place, and they want to keep the lights on and the doors open. And so increasing rents is sometimes necessary and has been explored by NeighborWorks organizations. Accessing or depleting operating reserves has been another response. Some organizations have taken precautions like making safety or natural disaster modifications to their properties. Others have postponed improvements or implemented a hiring freeze or decreased discretionary spending and expenses. Delaying future housing projects has also been an issue. Of course, if you can't get insurance for development or if things aren't penciling out because of prohibitively high costs of insurance, it's difficult to move forward with projects. Looking to the literature, I found that there was much more information more information available on issues that homeowners are facing with property insurance, such as dramatically increased insurance costs, high instances of underinsurance, increased debt, and declining home values. And not only did there seem to be a focus on single-family property coverage, there were also geographic focuses on California and Florida, discussing the respective regulatory and climate challenges that threaten the security of those insurance markets. So going through this exercise ultimately was helpful in honing my research to focus specifically on somewhat of a gap of available information on the experiences of geographically diverse multifamily affordable housing organizations and helpful strategies to support them. But still, reports and headlines document and underscore the difficulty affordable housing organizations face with rising insurance costs. And this is a study from Minneapolis Fed that highlights multifamily rental property owners' experience with struggling to cover operating expenses and even threats to plans for new development of affordable housing. Other headlines reveal impacts of insurance costs on affordability, as well as connections between climate change and rising insurance costs. Overall, although the literature seemed to focus on single-family insurance issues, many reports and papers elucidated the difficulty affordable housing organizations are facing in this space, further highlighting a need for strategies to manage these costs. So moving forward to my methods section, primarily I use semi-structured interviews with NeighborWorks organizations, policy advocates, and insurance risk advisors in order to begin to develop some strategies to address the overall question. So in deciding which states to include in the research, I thought a lot about how California, Texas, Florida, New Orleans, and others are discussed quite often as not only having extreme weather events, but also as having impacts of those events on property insurance rates or availability. And so I wanted to include perspectives of NeighborWorks organizations in some of those areas. I managed to speak with an organization in California and an organization in Florida. However, I also wanted to bring some geographic diversity to the question and to see how organizations are dealing with this in other states that maybe aren't as widely discussed in the news or in literature. And so I was able to speak with organizations in Virginia, Vermont, and North Carolina as well. And for the purposes of this presentation, I will keep sort of the information on each of these organizations somewhat limited in order to allow sort of more time to focus on the strategies that were shared with me throughout the interview process. But to give you a picture of the organizations that I just showed and their size and the kind of properties they have, Eden Housing, which is located in California, has more than 7,500 properties throughout the state, and they provide affordable housing for more than 65,000 people at multiple affordability levels. The Champlain Housing Trust is a community land trust located in the northwest region of Vermont, and they supply permanently affordable homes, and they own or manage over 2,600 apartments and steward 670 single-family shared equity homes. Better Housing Coalition is located in Richmond, Virginia, and they're Richmond's region's largest community development corporation. And they supply affordable housing in the form of 15 multifamily rental communities, 1,500 rental units, and 200 single-family homes. And the Community Development Corporation of Tampa is located in Florida, and they offer affordable rental and home ownership opportunities throughout Tampa and Hillsborough County. They have more than 820 development projects, including new construction, rehabilitation, and rental units. And last but not least, Mountain Housing Opportunities, is located in North Carolina, and they have more than 1,400 units of affordable housing. This is sort of comprehensive list of all the folks that I've spoken to in my research, and so I just wanted to extend a huge thank you to all of these people for their time and for their expertise. So I'll now move into some key insights from the research, which I've put into 5 buckets. The first is designing and developing to limit risk. The second is considering safety improvements and retrofits. The third is crafting an effective annual application. The fourth is considering self-insurance or different alternatives that would fit under the umbrella of what we might call self-insurance. And the fifth is advocacy efforts. So jumping now into the first bucket of designing and developing to limit risk, I thought about this on a smaller scale, so a site-specific scale, moving towards a more macro scale of the whole nation. And so starting with a macro scale of site plans, I know I said I would focus on property insurance. However, a couple techniques that could help on the builder's risk side came up in a few of the conversations I've had. And so I'll mention them quickly here as they might help organizations with being insured specifically in the standard market. And so insurance companies typically don't want to insure very large or very expensive buildings, and firewalls can be a strategy here to create consolidated fire risks. So for example, this building here would typically be considered one fire risk, but because the firewalls that I've noted in white, it would then turn into sort of 4 consolidated risks. And something else that can help on the builder's risk side is distance between buildings. And so if you have some space to play around in your site plan, if there's more than 100 feet between buildings, the buildings are typically considered separate fire risks. Okay, moving back now to property insurance. Geographic diversity is also important, so just balancing the spread of risk in your portfolio. So if you have properties with a lot of coastal exposure, then balancing that with properties in less risky areas can also help with your portfolio being insured in the standard market. And this can go into a larger land use issue of where we should build and whether or not we should build in especially risky areas. But insurance is sort of one piece of the puzzle here. And this can help with your overall risk in your portfolio. Another strategy that was brought up in a few interviews was locating bike rooms that store e-bikes away from other buildings or in a room with an installed sprinkler system in order to prevent sort of destructive fires that can happen from lithium-ion batteries. Another strategy is to think about resilient materials. And so the majority of the multifamily affordable housing stock is wood frame construction, and wood is typically cheaper than other building materials, but it also can be riskier in terms of fire. And so there's engineered fire retardant treated wood that burns a lot slower than non-treated or traditional lumber, and this can be more expensive, but depending on the fire risk of the area, it might be something worth looking into. Um, I touched earlier on thinking about sort of larger land use issues and building in less risky areas, but if an organization is designing and building properties in, say, a community with very high flood risk, it could be helpful to build up to several feet higher than the baseline, the base flood elevation or BFE. Okay, moving to the second bucket, which is considering safety improvements and retrofits. In speaking to some insurance risk advisors, by far the number one safety improvement that came up the most was implementing sort of stovetop fire stops, which are canisters that you can put over a four burner that will prevent kitchen fires. And these can be cost effective because they're relatively inexpensive and because the frequency and cost of kitchen fires can be quite high. Um, Here, risk advisors suggested reviewing the different competitors in the field, as some can last longer than others or be less impacted by the cooking habits of residents. Another helpful retrofit could be water overflow sensors, which are devices that can alert the start of water overflow, and they can help prevent sort of more major leaks that could be quite costly. Bollards can also help, and so depending on the location of a property, bollards might be something to look into. Roofs came up in quite a number of conversations, and roof replacements, enforcements, or fortified roofs can be helpful, especially in areas with strong storms and wind. And with any safety improvement or retrofit, it's really important to keep receipts of that maintenance and to really chronicle all of the safety improvements that you make to your property, and then to include receipts of those in your annual insurance application. Insurance companies care a lot about things like roofs, electrical paneling, and electrical wiring. And so, especially for those maintenance or repairs, receipts would be particularly useful. But any of these safety improvements play a role in the overall story that you tell in your application. So, the third bucket sort of goes along with that, and that's crafting an effective annual application. Including a thorough statement of values, which is an Excel spreadsheet of all your properties and sort of all the details about them, as well as including a cover letter in your application is helpful. Here, you really want to tell a story and a narrative about why you're safer than your peer group. And your application should sort of also stand out amongst the group. And unfortunately, I've heard the analogy here of insurance applications to competitive college applications. So in both, there's only a specific percent of applications that will be let in, of applicants that will be let in, and typically their applications sort of have stood out in some way. And so here, it's important to craft an effective narrative. The next strategy may seem a bit obvious, but limiting the amount and duration of claims. Claims can really significantly increase your premiums for years. And so if there's something that you can take care of with existing maintenance staff and sort of keep off of your application, it could result in long-term premium savings. The last strategy here is fostering a good relationship with your underwriter and your broker. And this could look like prioritizing showing your underwriter a property in person and being strategic and thoughtful about which one you show. And so maybe you're showing safety improvements you've made or retrofits you've put into the property to add to this overall story of why your property is less risky. The fourth bucket is to consider things that fall under the umbrella of self-insurance. These strategies are particularly useful for larger organizations, maybe with upfront capital, and they wouldn't work for every organization. But some things to consider here are captives or deductible reimbursement policies, which are captive-like structures. And these would work would work best again with larger organizations with upfront capital, but also sort of with organizations that have an entrepreneurial drive. High deductible policies are also useful sometimes, and the idea here is that if you have a higher deductible, then your premiums would be lower. In some states, that might translate to if you have a higher deductible, then you're more likely to get insurance at all. But if you're able to create a significant deductible fund, which of course not every organization can, this can help lower your premiums or help you procure insurance. The last bucket here is to advocate. Your organization can really do everything right and still come up against a lot of challenges with insurance. And there are a few advocacy strategies that folks have pointed out in interviews. So one has been around increased data collection and regulation. Currently, insurance isn't really transparent about their coverage at all, but especially for affordable housing, property insurance coverage, there's just not a lot of information out. And so in getting a clearer picture of coverage and what it looks like, we'd be able to craft more effective advocacy efforts. Another recommendation that came up in a few interviews is thinking about a federal or state public reinsurance program. And the idea here is that this would take pressure off of insurance companies due to availability issues with reinsurance, which is basically insurance for insurance companies. And this could fall at multiple scales, depending on whether or not this falls among the priorities of the federal government. It might be more applicable on a state or a regional basis. And a similar backstop was implemented sort of in the commercial market after 9/11 with the Terrorism Risk Insurance Act. And so similar things have been implemented in the past. And here, some interviewees have stressed that the relief should not be felt primarily by insurance companies and that we might consider something from insurance companies in exchange, such as a requirement that they, say, participate more usefully in the market for affordable housing providers. The third strategy here under this bucket is advocating for risk mitigation programs. So there are existing grants for affordable housing to make retrofits and safety improvements, but they're really few and far between, and they're quite competitive to get. And so just offering more widely available risk mitigation grants could be helpful both to safety and to risk from an insurance standpoint. Okay, to go over these 5 buckets quickly one more time. The first we discussed was designing and developing to limit risks. So this could look like something on a micro scale, like a site plan, and the specific layout of buildings, or on a more macro scale, and where you're specifically locating your properties sort of in terms of coastal or geographic risk. The second bucket was considering safety improvements or retrofits, so things like stovetop fire stops or leak detection monitors, and to really chronicle all of these updates. The third is to craft an effective annual application, and this could look like including a thorough cover letter and statement of values, also maintaining a strong relationship with your underwriter and broker, and sort of overall telling the story of why your organization is safer. The fourth strategy here would be primarily helpful for larger organizations, but this could be considering alternative programs that fall under self-insurance, including captives, deductible reimbursement policies, and electing to have a higher deductible. And the final strategy is advocacy efforts. So there are quite a few advocacy strategies that were brought up in interviews, including advocating for state-backed reinsurance, advocating for more transparency amongst insurance rates and availability, and advocating for state-run policies that could fund risk mitigation and safety improvements. I want to acknowledge that many of you might be thinking that if the strategies to achieve a good insurance application require appearing safer than your peer group, then other organizations will inherently be left behind to bear high rates or to have difficulty procuring insurance. And others might question the role insurance serves if a strategy is to not file claims, but to acquire insurance regardless. And if a competitive insurance space is not conducive to preserving affordability or even to an equitable distribution of cost burden, then how might we address the issue of volatile insurance rates in an equitable way? So throughout this project, I've thought quite a bit about the urgency that is needed in addressing volatile and rising insurance costs, which led me to pursue an approach that looked specifically for implementable suggestions in the near term for organizations. However, many of my conversations ended with discussing how advocacy and pushing for policy reform are important or even necessary as steps to achieving manageable insurance rates for all. And the conversations on advocacy seem to push for three main things: resilience, reliability, and fairness. So, although insurance is not a risk mitigation tool, many conversations posited that even as a risk financing tool, it can be better integrated into a cycle that encourages resilient improvements to properties as well as climate resilient development. So, in order to promote more resilient housing as well as more development, it's important that organizations be rewarded for resiliency efforts through lower rates, and that intersections between emerging technologies in the housing space, such as new methods for safer building structures, are acknowledged with lower rates as well. Reliability would mean that organizations can predict insurance costs and availability, and although there are many varying definitions of what fair insurance pricing could look like, many conversations introduce ideas of discounts or other kinds of support for affordable housing. And although I did not set out to address how we might position our advocacy efforts to center affordability and resilience within the current context of predominantly private insurance markets, nor do I really have a straightforward answer to it, it is a question that gained increasing importance to me throughout the research process. And ultimately, I wanted to provide strategies that may be immediately helpful to organizations who might not have the means to acquire specialized risk advisors. But I also really want to highlight here the strong appetite among affordable housing organizations that already exists to advocate for fairer insurance. And in doing so, I hope to encourage increased statewide collaborations for policy advocacy and reform both in and out of the NeighborWorks network. Thank you.
Ariella, thank you. Really interesting presentation, and we have some terrific questions. I want to actually pick up on a little bit where you just ended, which is I'm wondering from your conversations about the capacity of the varying community-based organizations to really engage thoughtfully in the insurance markets. It strikes me that I'm just wondering, do these organizations have within them, people who really can do the kinds of things you've been talking about, or is that something that you're finding people have to kind of learn to add that skill on the fly?
Yeah. And David, you're asking specifically about implementing suggestions or about
Yeah, well, as one thinks through some of the suggestions you made, not so much on the advocacy, but on the really your first 2 points,
yeah.
um, how do you think there's some sort of interesting, careful analyses that you have to do, including having to understand how insurance markets work or don't work. And I'm just wondering, and I think you referred to this a little bit at the end of the need for statewide coalitions for perhaps smaller community-based organizations that may not have somebody on staff who really understands this at the level of detail. But I didn't know whether that was something that came across as uh, a significant issue, just the sort of human capacity to do what you're suggesting.
Yeah, and there were a lot of strategies listed, and of course, an organization can't even
Yep.
begin. Many organizations can't even begin to do half of them. One strategy that sort of was brought up as the most important, or maybe even the most impactful, um, in terms of sort of like retrofits or implementable strategies, was stovetop fire stops. Many organizations like offer a set discount. On insurance for using stovetop fire stops. And so that was sort of highlighted to me as where organizations should sort of start if they sort of have the capacity to do one of those things. But this is going to vary again by region and by insurance company.
Yep. Um, Another question about sort of the need for diligent maintenance and reserve funding. A lot of some of your strategies sort of rely on making sure you've got adequate reserves. And I'm just wondering again if your research led you, was that an issue of just given all the other pressures that folks felt like they were able to kind of maintain adequate reserves.
Definitely. That was an issue that a lot of organizations brought up. It was primarily it's helpful for larger organizations, maybe with more upfront capital to sort of put aside money, but many organizations can't. Um, and so yeah, I mean the difficulty that the volatile property insurance rates and availability brought upon organizations really struck me throughout this process. Um, yeah, I mean, and I didn't touch on this in my presentation, but um, some organizations have actually had to sort of go belly up and sell off properties
Hmm.
due to rising insurance costs as one of the factors.
Interesting. This is an easy question. We had a request asking if it would be possible for you to stop sharing your screen because it's
I absolutely can do that.
uh,
Apologies.
no, not a problem. Um, there were a couple questions about data. I think I know the answer, but I'm going to ask them anyway. One is, you started, from a point of that insurance companies have this perception that affordable housing is, in fact, more risky than other forms of multifamily housing. And I'm wondering, do you know of any work on whether or not that actually is the case?
Yeah, so that was something that came up sort of anecdotally in quite a few interviews. I'm not sure that insurance companies would sort of outright admit to this, but something that came up in conversations was that sort of only a handful of insurance companies will actually um, insure affordable housing.
Yep. Yep. Um, and one last question before we wrap this one up. A couple of people have asked about whether you ran across any examples of nonprofits, geographically diverse nonprofits, sort of coming together to purchase risk, in basically in order to diversify their geographic risk. And we heard this from a couple different practitioners. Since most of the NeighborWorks organizations tend to be very place-based.
Yeah, I mean there are examples of captives that do this. Um, and I didn't go into this in the presentation, but that would be a form of self-insurance. But
Yeah,
yeah.
but no, nobody has figured out sort of how to structure a marketplace that might um, allow sort of that geographic risk. I mean, I think you've touched on this that in general there seems to be a greater need for data and somehow engaging with insurers and the investors in insurers um, to sort of get at this problem, which I thought was a pretty interesting and important point. And of course, being the Joint Center, we're always in favor of more data. We have tons more questions, but we don't have tons more time. I just want to thank you. I think this was a really terrific and thoughtful presentation and, wrestling with what's turning out to be a critically important issue, but one that, at least until recently, has really flown under the radar. So it's really, for me, been a model of what we hope Gramlich work will look like. So thank you. You may want to take a look at some of the questions. And now I'm going to turn it over to Zach, and we're going to uh, change. So as I said, Zack Lively, also a Master of Urban Planning student, will be talking with us about some recent experiences that several community-based organizations have had with limited equity co-ops. Zack, it's all yours.
Great. Thanks, David. And I assume you can see my slides.
Yes.
Perfect. All right. Well, hello, everyone, and thank you for joining today's webinar. As David just mentioned, my name is Zack Lively, and I'm a second-year Master in Urban Planning student here at Harvard's Graduate School of Design. I've had the pleasure of working as a Gramlich Fellow since this past summer at the Joint Center and in collaboration with NeighborWorks America. And I'm excited to present an abridged version of the findings from my forthcoming working paper in this presentation titled Taking Stock: Recent Efforts to Create Limited Equity Housing Cooperatives. So, to provide some context for this project, many believe that to remedy today's unflagging housing affordability crisis, that the toolbox of solutions must grow. And against this backdrop, efforts to create limited equity cooperatives, a model that has long been associated primarily with just a small handful of northeastern markets, are getting underway in an array of different places and sometimes in surprising cities. So, to provide just one illustrative example, Nashville's Barnes Housing Trust Fund released a $7 million request for proposals for limited equity cooperative development projects in 2023, setting the stage for the first publicly funded housing cooperative in the city's history. And yet, even as the limited equity cooperative garners this new interest, many markets confront the issue of having few local examples to draw lessons from when assessing when and how to deploy this prospective solution. And so this means that while the model may be well suited to play a role among the existing suite of tools for addressing housing challenges, the absence of this recent precedent limits this potential. And so the focus of this project has been on examining recent utilization of the limited equity cooperative model in cities around the country to answer the research question, what do recent practitioner experiences reveal about the role and use of limited equity cooperatives in addressing ongoing housing challenges? In other words, what problems are people responding to, and how are they implementing these solutions, with the goal being to compile a practical resource for practitioners that are exploring this model that is informed by the past experiences of those that have been engaged in related work. And to share the findings of my work aimed at answering this question, this presentation is broken into three parts, with the first being takeaways resulting from a scan of the field, the second being two notable case studies, and then finally concluding with lessons for future efforts that is drawn from all of this work. So, to begin gauging recent activity, the study's landscape scan relied on a mix of independent research as well as snowball sampling based on recommendations from practitioners. And together, these sources pointed me in several directions, with this map here showing many of the cities that contain efforts that were examined during this first pass. And from these, it quickly became clear that there's not one way to create new limited equity cooperatives. Instead, to provide just one salient difference, in some places, groups have turned to new construction projects, whereas groups in other places have prioritized preservation, and groups in some have sought to tackle both. And so, from this broader array of cases, a subset were then selected to be examined more closely, with the goal being to learn from a cross section of cases that span many facets of this current moment in the field. And I would just emphasize that when doing this, conversations with practitioners and researchers were vital. This slide here shows many of the people that were generous enough to speak with me and to illustrate the balance of perspectives. I've separated this slide out into four different categories: those who provided insights informed by recent projects, those with a sector-wide perspective, those who are researchers, and importantly, my two mentors, Jenny Gaynor of NeighborWorks America, and then David Luberoff of the Joint Center, who have both provided invaluable guidance throughout this project. So altogether, these conversations pointed to several different takeaways, and in this presentation, I'm going to highlight six that relate to practitioners' recent approaches to creating limited equity cooperatives. With the first being that projects are varied, and I've already kind of previewed this, but it's not only the case that some practitioners are targeting new construction while others target preservation, but these efforts also differ along many other dimensions as well, such as their emphasis on serving low, moderate, or even middle income households, as well as overall project size, with completed examples ranging from less than 10 units up to several dozen. And in addition to that, when looking across these cases, it's clear that special arrangements for acquisition and development are common. And what I mean here is that in preservation projects, practitioners are often struggling to prepare residents or secure financing at the speed of the real estate market. And so as a result, they're deploying strategies that create a more flexible timeline, like purchasing and temporarily holding properties before conversion. Among other places, this was ultimately the case in Nashville, where the team that received the city's funding used the money to actually acquire an off-market property for conversion prior to being able to engage residents. And generally speaking, this same principle holds true in new construction cases, though it looks different. And so practitioners are often relying on an arrangement with maybe the public sector or another patient landholder to provide the site when development is ready to commence, again, creating a more flexible timeline. And when looking across these cases, it's clear that there is also not a standard financing model, but subsidies are essential. And what's interesting to see is that when comparing these different financing strategies, practitioners are not just turning to different sources from one another, such as a local, or rather a reliance on local CDFI loans in cities like Missoula versus a reliance on larger HUD loans, such as through the 213 program, which has recently gained some appeal in cities like Seattle. But actually, across these cases, capital stacks are structured much differently, whereas some rely on households to contribute up to a few $100,000 to help cover project costs. Others require virtually nothing. And this difference sets the stage for the next takeaway, which is that there are also significant differences in asset building opportunities through cooperative shares. So when households make larger investments, they're often using share loans to finance these transactions, which of course then enables them to pay down the principal over time and also accrue modest appreciation on a leveraged investment. And as a result, this may translate to a large asset when they leave the cooperative, depending on their extent of stay. And it seems to be most prevalent in projects that are tailored to higher income households for reasons that I will return to later. In contrast, in many other cases, households are purchasing shares that are equal in size to maybe just a security deposit. And because the resale formula only allows for a little bit of appreciation, that means that when they leave, there really hasn't been much asset building that has occurred at all. And the fifth takeaway is that rigorous support and oversight arrangements to ensure that these projects provide long-lasting housing security and affordability are frequently used. And this is a really important feature of these projects. And in the case studies, I'll tease out two different approaches. And then finally, the recent results show uneven progress, whereas there have been recently completed projects in new cities like Missoula, Montana, and Seattle, as well as cities with longstanding commitments to the model like New York. There are also places where projects have encountered difficulties. And in the interest of time, I'm not going to dwell on this for too long, but I would say that when examining these frictions, they appear to be most pronounced for larger new construction projects where building the requisite capital stack has hindered some groups' efforts to date, particularly when it comes to accessing construction loans. Specifically, this study examined two such examples, one of which that is also in Seattle and one in Portland, Maine, that are aiming to have between 68 and 90 units. However, both remain in planning after several years due to issues securing the necessary financing. And so this is a topic that you can expect to see more about in the forthcoming working paper for this project. And I'd also be happy to take questions about these kinds of projects during the Q&A. But now I am going to try to add some color to the findings that were just shared by looking at two notable examples, one from Missoula, Montana, that has been all about preservation, and one from New York City that blends preservation and new construction. So I'll start with Missoula, where there are two groups, Front Step Community Land Trust and NeighborWorks Montana, have been building a model to stabilize unsubsidized affordable rental housing by using limited equity cooperatives. And since starting in 2021, they've completed two projects and they plan to pursue more in the future. To set some background, the team describes a dwindling supply of unsubsidized, low-cost rentals in the city, as well as mounting pressures on tenants that is resulting from a confluence of recent market appreciation as well as ownership turnover. And so, to try to address these challenges, the team has built a model that capitalizes on complementary capacities. NeighborWorks Montana has 15 years of experience supporting cooperative conversions and manufactured home parks through the resident-owned community model. They've completed 22 of those projects, and they also bring access to capital through their CDFI arm. On the other hand, Front Step has operated a community land trust for 3 decades in Missoula, and they bring experience in resident organizing and then, of course, stewarding permanently affordable housing. As for the actual sites of these interventions, the team has worked at properties where ownership turnover is underway and tenants want greater control over their housing, but they are limited in their ownership options due to lower incomes and an inability to access traditional mortgage financing. And so this highlights a key reason why this model has worked for the team because the cooperative purchases and holds the property. This has enabled local lenders, including NeighborWorks Montana, to use information like projected rental income rather than household finances as the basis for underwriting. And to just take a closer look at the group's actual implementation process, in both cases, the team began these conversions by assessing residents' interest in pursuing the cooperative conversion, and they decided in advance that they would only proceed if at least 60% sign on. They ultimately cleared this threshold in both cases, and then the team worked with groups of resident leaders to structure the cooperative and build the skills internally to serve on the board of directors post-conversion while also beginning capital planning. Whereas the resident engagement strategy was generally similar across these cases, the acquisition strategy differed, and that's because in the first project, the team encountered the issue of the property seller simply just wanting to get the best offer as fast as possible. And so to create that more flexible timeline that I had mentioned earlier, the team in this case worked with an experienced rental housing operator who was willing to purchase and temporarily hold the property while the team resolve those issues like preparing residents and securing the necessary financing. In the second project, this wasn't so much of an issue because they worked with a patient seller who was interested in the prospect of securing community benefits, and so that enabled the team to work on a more flexible timeline. Just a couple notes on financing. The first project that the team pursued was an 8-unit building, and they relied primarily on a $567,000 loan provided by NeighborWorks Montana, a $300,000 grant from Missoula's Housing Trust Fund, and a $120,000 philanthropic grant that was treated as share purchases sized to $15,000 per household. The group's second project wasn't too different. This is a 14-unit project that relied on a $720,000 first mortgage, this time provided by a local credit union. NeighborWorks Montana provided the subordinate mortgage, specifically in the size of $525,000. And again, there was a $300,000 grant that was provided by Missoula's Housing Trust Fund. In terms of the outcomes, the average carrying charge for residents post-conversion was $890, and both cooperatives set income restrictions for new members at 80% area median income, which was approximately $71,000 for a family of 3 in 2025. And as for the cost of entry, I've described this already somewhat, but it's important to note that resident preference played a big role in ultimately determining how shares were sized. And so in the first project, with the help of that philanthropic grant that led to shares sized to $15,000 per household, and the annual appreciation rate was 3%, or set to 3%. And in the second project, again, largely due to resident preference, they landed at $1,500 per household with no appreciation at all. In both projects, obviously, the buildings are owned and governed by residents with boards for these cooperatives ranging up to 3 to 5 members in size. But the land, on the other hand, is owned by Front Step and provided to the group, or rather provided to the cooperatives on long-term ground leases. And so as I previewed earlier, groups have sought to embed support and oversight in different ways, and this is one of the mechanisms that groups have used. The added layer of a CLT keeps knowledgeable staff nearby to support when needed, while also ensuring that affordability is maintained in perpetuity. And then finally, whereas the group's first project took 2 years to complete, the time needed for the second project was brought down to 9 months. And in fact, just this past December, NeighborWorks Montana expanded the limited equity cooperative community land trust hybrid model for the first time to another part of the state, West Yellowstone, where they helped to convert this 18-unit multifamily rental property that was also for sale into a limited equity cooperative. And in this case, NeighborWorks Montana was able to help residents accomplish this in just 6 months. And so looking across these three cases, you start to see that there is an opportunity for efficiency gains as groups gain experience. So the second case that I'll now highlight is New York City, where the group Asian Americans for Equality have led several efforts to create new limited equity cooperatives. And primarily these have been through the city's Affordable Neighborhood Cooperative Program, or ANCP, which is the focus here. After they completed the program's inaugural project in 2016, they're now nearing completion on their third effort for a total of 89 units of limited equity cooperative housing. To set some background again, of course, this is much different than in Missoula. ANCP was born out of a need for the city's Department of Housing Preservation and Development to create a disposition strategy that would be capable of resolving a longstanding backlog of buildings acquired by the city because of tax foreclosure and owner abandonment, and that have long been slated for tenant ownership. These buildings in this pipeline, they face several challenges. So they're often physically distressed, only partially occupied, and home to primarily low-income residents. And in most cases, these physical challenges can be addressed through a gut rehabilitation, though in rare cases, they can be so severe that demolition and redevelopment are required. And so this is actually the case in the ANCP project that AFI is currently wrapping up, which, due to structural issues, has resulted in a newly constructed 23-unit building that they're currently filling vacant units in. And then, in addition to these challenges, there's also this key affordability challenge. So while the city makes up to $560,000 per unit in capital that functions much like a grant for these projects, private construction financing is also leveraged that importantly risks compromising the affordability of these units for their low-income residents if converted to permanent financing once the cooperative conversion finishes. And so in order to address this collection of challenges, on the city's end, residents' interest in converting their building to a limited equity cooperative is first gauged. And in these projects, the conversion only proceeds if at least 80% sign on. And if 80% do sign on, the city then partners with organizations like AFI to manage construction and conversion, while residents also get to influence which group is selected. On AFI's end, once they are selected, of course, working with residents is one key facet of these projects. So AFI will help residents to find a temporary apartment to move to, consult with them on the building's redesign, and usually need to even get their approval on key design decisions. And then AFI also works with other local organizations like the Urban Homesteading Assistance Board, or UHAB, to ensure that residents receive all required training needed to join the cooperative. And in addition to this, AFI also puts together the financing package for these projects that resolves that affordability issue that I described. And to illustrate how this works in ANCP projects broadly, I'm going to use AFI's second project as an example, which is a 44-unit, three-building gut rehab that was completed in 2023. And when rehabilitation commenced, there were 23 occupied units and 21 vacancies. And after securing $9 million in city subsidy, or $204,000 per unit, AFI needed to fill a gap that was approximately $11 million. And the lion's share of this was financed by a $9.7 million construction loan from LISC, which allowed them to complete the rehabilitation. And then once finished, to actually address this affordability issue, what the program allows is For the cooperative shares of the vacant units, in this case, the 21 vacant units, were sold to households at up to 110% area median income. And what's going on here is because these households at this income level can afford significantly more than what the building's carrying costs entail, which in this case ranged from $811 to $1,185 based on bedroom size. This means that these new residents can finance shares sized up to a few $100,000 with the help of private lenders. And so in this project, this equated to shares sized to $300,000 per household on average, which then injected $6.3 million in capital that defrayed the construction loan while also importantly creating affordable ownership opportunities for moderate to middle income households with real asset building potential. And then on the other hand, the residents for the 23 units who resided in the building before rehabilitation, the cost of entry is set to just $250 to $2,500 based on income. And so altogether, the permanent financing as a result is just $3 million, which I would point out that, like in Missoula, is at the cooperative level, again, avoiding household level access to credit issues, and combined with the low share sizes, this ensures that even the low-income households that reside in this building before conversion are not excluded from the opportunity to participate in the building's ownership, though they can also elect to have their unit become a rent-stabilized apartment should they choose. And as just one more note before moving on, I'd point out that in the more rare new construction project that AFIA is wrapping up, that while the same approach was applied, that project costs on a per unit basis were much higher because new construction is, of course, more expensive than rehabilitating a building, which specifically I think that the per unit costs were a bit more than double, and the shares are sized to be approximately $311,000 on average. And so in terms of outcomes, whereas residents previously resided in what are typically distressed buildings, they secure a rehabbed unit that is new and up to date and improving quality of life. And if a household's income presents a cost burden risk, Section 8 vouchers are also made available. All residents also get access to a large asset building opportunity, which is one of the features of these projects that I really want to highlight. So even though new and existing residents pay considerably different amounts to join the cooperative, all are permitted to sell their shares at values affordable to households at their building's income restriction. And so, of course, it should be noted that while this avoids an issue of households being on wildly different asset building trajectories, it also means that a portion of units previously affordable to low-income households are only kept permanently affordable at the income restricted level. And then, like in Missoula, buildings are owned and governed by residents, but in terms of the support and oversight, it is embedded in these projects in a different way. And so specifically, cooperatives, as a condition of accessing the city capital that funds the rehabilitation, they agree to a regulatory agreement that makes key stipulations regarding various different things, such as resale policies, election processes, annual budgeting, and more. And then cooperatives work with what is called a monitor on an ongoing basis to ensure that they're operating accordingly and to help them if and when they need support in the future. And then as enforcement, cooperatives face significant financial liabilities, like potentially having to repay the city capital if the agreement is irrecoverably violated. And to just highlight the transformation that these efforts help to deliver for residents, this is the before and after of the new construction project that AFI is currently filling vacant units in. All right, and so the last part of this presentation will now turn to an abridged version of my lessons for future efforts, which is drawn from everything that was learned over the course of this study. And these are broken into two different sections, with the first concerning three big points regarding the role and use of limited equity cooperatives in addressing ongoing housing challenges. And the first of these is that limited equity cooperatives seem poised to help address housing stability challenges at a minimum, as demonstrated most clearly by the Missoula case. By providing a more accessible form of homeownership, the model increases resident control and eliminates risks posed by investor operators. And so, particularly in contrast to conditions where households face unstable rental housing, this may be an appealing alternative, particularly for households that otherwise struggle to find an on-ramp to home ownership due to factors like lower incomes. And to build on this, to the extent that asset building is a goal in these efforts, this seems to be easiest to achieve when share financing is available. But because this presents many access to credit issues, whether that be due to a borrower's background or simply because the loan would be need to be sized so small to be affordable, projects tailored to lower income households as a result seem to struggle to incorporate this feature in practice. As the New York City case demonstrated, under the right circumstances, resale formulas may offer a way to circumvent this, but to be clear, this does risk compromising deeper affordability as a result. And then finally, support and oversight are essential to success. This includes supporting residents through the challenging startup work, sticking around to support cooperatives as issues arise in the future, and then, of course, ensuring that permanent affordability is maintained. And I would just underscore that throughout the course of this research, combining limited equity cooperatives and community land trusts when the cooperative is created was continuously cited as a popular strategy for embedding this support and oversight into these projects over the long run. In addition to these lessons, there were several other important insights that surfaced over the course of this project, and I'll quickly run through these, with the first being that particularly in the case of preservation, it is important that when considering whether to deploy this model, that early planning also include a consideration of alternatives. And what I mean here is that residents' choices are sometimes shaped by troubling constraints like fear of displacement, in addition to just genuine preference. And so situations like this can make cooperative ownership, as one practitioner that has worked on similar projects described, the best of bad alternatives. And so this is why planning should ideally consider alternatives that will hopefully reflect the goals of residents. And I think that in the New York City case, it offers an interesting model for how to do this. Households, when demand for the cooperative is low, can have their building become affordable rental housing instead, giving households real choice. And in a similar vein, the second lesson is to approach efforts pragmatically. These projects are complicated and they're not guaranteed to succeed. And so to mitigate these risks, practitioners recommended starting with smaller initiatives and also doing contingency planning at project outset to both keep projects manageable and avoid seeing an effort turn into a drawn-out struggle, which, especially for early efforts, is a situation that not only has negative implications for the lead organization, but it also risks leaving the model with a bad reputation among public funders and other key partners that took a chance on a novel approach. To shift gears a bit, the third lesson is that pipelines are better than one-off projects due to both the expertise needed to create limited equity cooperatives and the ongoing support required to sustain them. It seems to be most effective for the model to be a routine part of an organization's toolbox rather than a one-time intervention that is then left to be an anomaly out on its own. And in terms of what is needed to actually make this happen, these projects need capital that is fast and flexible, because practitioners are frequently acting opportunistically in response to unpredictable circumstances. And so this necessitates capital that meets those conditions. And building on this point, policy changes are also needed to create more opportunities for rental conversions. Most markets preference private investors in quick closes, making a circuit breaker policy akin to a tenant or community opportunity to purchase act necessary to help level the playing field and give tenants and community groups an opportunity to step in. And as for additional obstacles that groups engaged in this work are likely to encounter, one is that preservation projects frequently present physical and affordability challenges. So in existing properties, upfront investments and long-term capital planning are essential to setting cooperatives on a strong trajectory, but financing these initial repairs in addition to the acquisition in a way that is affordable for residents can be difficult, as they will generally have a range of different incomes. And so absent adequate subsidy, this can result in increased monthly costs for residents, and some households may even be cost burdened initially. To illustrate this point, in the two Missoula projects, the average increase in cost for residents post-conversion was $140. And then my last insight is that support is needed to offset organizational expenses. Because these efforts are resource intensive, practitioners reported needing to secure supplemental funding to account for the staff time and other expenses incurred pursuing them. And so, to ensure that organizations can continue to support residents in their aims to secure greater control over their housing, access to more funding resources that support the cost of pursuing these projects is needed. And that's it. So thank you all, and I would be happy to take some questions.
Zach, thank you. Again, similar to Ariella, you waded into what perhaps on the surface looks like a pretty simple question, and has as you and I have discussed often, um, a whole bunch of layers of complexity. And again, as with Ariella, we have many more terrific questions than we have time available, but we will share those with you because some of them are things that you may want to follow up on. But let me pick a couple out in the few minutes that we do have. Um, Several people asked about strategies to ensure that co-ops basically that the co-op boards basically are setting aside enough money, for maintenance and other expenses, um, and so that they sort of protect the asset over time, and wondering what kinds of structures you've seen in terms of how some of the organizers of limited equity co-ops have kind of gone about that.
Yeah, absolutely. That's an important topic, and really across the board, groups have been keen on mitigating the risks that not engaging in a reserve, like setting aside reserves would pose. And so I think it looks different across cases. In New York, by virtue of that regulatory agreement, it makes specific stipulations about what cooperatives need to do, and then that monitor would ensure that that is actively taking place in a city like Missoula, where they use the community land trust structure. That there would then be a more like a more natural relationship between the CLT that would ensure that groups are doing that. And I know that in addition to ensuring that they make regular contributions, that groups have also been keen on starting with a significant reserve as well, so that these cooperatives are really set up to succeed over the long term.
So let me make sure I understand that point. So that in the CLT case in Missoula, or the sort of agreements in New York, there are some requirements that basically say you need to have these capital reserves, and presumably there is some consequence if you don't maintain it. Did I get that right?
Yeah, no, that's right.
Okay, good. Couple of questions about the funding, uh, how, I guess particularly New York, how are folks funding those sort of large share buy-ins? Are they getting some form of loans? Are lenders proving to be willing to provide such loans?
Yeah, so I think I can't, everyone's situation is going to be different, but I think that most people that are purchasing a share size to a few $100,000 will be relying on share financing to do that. And New York is obviously a bit of an atypical case because they have a long history of cooperative development. And so to some extent, lenders in the city may be more comfortable financing or familiar with financing these share loans. But even outside of New York City, in other cities, when households are making these larger investments at the outset, they are relying on share financing. And over the course of the research, credit unions emerged as a popular partner for making that possible, with some groups reporting success accessing loans as small as $50,000 from local credit unions to finance share transactions.
Excellent. And I want to circle back to one of the points you made when you started. I mean, given all the points that you've presented, you made the point that at least anecdotally, um, the large new construction projects that you looked at often seem to have been having a harder time. And given what you've just told us, any thoughts on why that tends to be the case, why that has seemed to be the case, at least so far?
particularly when it comes to these newer markets that have less of a history with the model, it seems that some groups have struggled to get construction lenders on board, and just due to various re reasons, whether that be unfamiliarity or something else, it's hard to fully know. But the access to construction financing has been an obstacle, and so groups, as a result, have turned to programs like the 213 program through HUD, which uh, promises to maybe remedy that issue by providing a guaranteed pathway to construction financing. But it is not yet. It remains to be seen whether groups can pull that off, as no one has yet succeeded in doing that. But there are some efforts underway in Seattle that will prove as a test case for that possibility.
Um, as I said, we've got many more questions than time. We are at the end of our time. I just want to say that, the Gramlich Fellowship goes back now, I believe, to 1999. So we're in something like our 26th year. Um, and it's remarkable to look over that as students like Zach and Ariella have engaged with what were the pressing issues of the day. If you look through on our website the list of all of the topics, it really that Gramlich Fellows have done, it really is kind of a history of the particular timely challenges in the housing market. We're happy that the Gramlich Fellows is going to continue. If you are a Harvard graduate student on this webinar, or know of a Harvard graduate student who will be returning to school in the fall, I strongly encourage you to think about applying for the fellowship. The application is pretty straightforward, and is due, as I said, a week from Tuesday. More broadly, both Zach and Ariella took on um, particularly sort of thorny challenges. The bulk of their work was done over 10 weeks over the summer. They've been honing and working on their papers this fall. And I just want to laud both of you and thank both of you for really shining a light on two really important and often little understood issues. I think in both cases, your research will prove to be both valuable to us as researchers at the Joint Center, but also valuable to practitioners in the NeighborWorks network, and the many folks on the call, and you'll see this in the Q&A, who are involved with either practice or policy making, or a little bit of both. So I hope everybody has a terrific afternoon, and hope that many of you will tune in 2 weeks when our next webinar will focus on the nature of and extent of the rapid rise in rural house prices that occurred during COVID. Thank you very much, everybody, and have a great afternoon.